Guys, good morning. December 2019, Wednesday. We're going to teach you how to be extra patient and how to stair-step into your trades on days like today. The typical mistake that a trader makes, thinking, oh, the market is going to go substantially lower after they're going to announce the decision at 2 p.m. Or they think, oh, no, the market is going to go substantially higher. Oftentimes, when you have this type of reasoning, you often miscalculate the third outcome, which is the market goes absolutely nowhere. And why would the market go absolutely nowhere? Keep trading in this sort of range-bound area between 31.31 and 31.50. Well, because if there is nothing that is going to be announced between 2 and 3 p.m. today that investors have already not calculated, then don't expect any substantial moves to the upside or the downside. This point number one is highly valuable from the day trading or swing trading perspective because you don't want to buy puts or calls out of the money. So it's actually, we've making some studies and analysis on some traders on days like today when Federal Reserve actually is announcing interest rate decisions. And oftentimes, a trader tends to believe that the move is going to be significant. But at times, after certain decisions, the market barely moves. And that could be an outcome today that we should not neglect. Therefore, stay with buying options in the money or near the money. The next important thing is make sure that you don't buy your position all in one shot. Guys, this is super important because when the market opens today, the options are going to be overpriced. Meaning, just like most of the market participants are expecting this bigger size move, they're not willing to sell the options at regular premiums. So they are going to be inflated premiums if you buy them before 2, 3 p.m. So with that said, at the same time, you don't want to miss the ultimate outcome. What if the market indeed does make a big move? Because there is a slight probability of that. Okay, so to protect yourself, you don't want to go in and risk your entire account or a large portion of your account, but at the same time, you don't want to potentially miss the move. So the smartest way to do it is to just start buying some options, maybe around 10:11, 10:30, not many. So let's say you're planning on buying 12 contracts altogether. So maybe start buying 2 contracts around 10:11. Okay, add some 2-3 more contracts around 3 p.m. and add a substantially larger amount tomorrow morning. Because in days like today, this is what's going to happen. You get a knee-jerk reaction around 2:30 when the conference starts. The decision will be announced at 2 o'clock, but sometimes it's not the decision that actually moves the market. Most of the time, the decision is already going to be calculated in. So the decision that has the highest probability, there's going to be no change. They're not going to cut the rates. They're not going to raise the rates. There's got to absolutely nothing. So everybody's going to be paying attention to what is actually any indication of what the Fed policy could be in the future. Like they're going to be trying to calculate what is the probability of a cut or a raise or any type of change in the Fed policy like in July. Okay, so that's what everybody's going to be paying attention to. And because the July timeframe is so far out, it may not have any significant impact on the market right now, short term, meaning like in the next week or two. So, but the catalyst that the market could use to move higher is pretty much non-existent because what we've pointed out in the video yesterday, everything has been priced in. And this is the ultimate type of scenario because everybody is relaxed. Everybody thinks they got everything figured out and they think everything is just going to stay bullish through the rest of the year. Statistically, yes, they are correct. But we're going to show you some statistics that they are not looking at that took everybody off guard last December. We're not saying it's going to repeat exactly this type of scenario this December, but we are noticing some similarities that could actually tank this market easily 100, 150 points on S&P, and considering that the options are so cheap right now, guys, it's not about, okay, how big the move could be. I mean, you don't need a 500-point move in S&P to make a lot of money, okay? What is important is how much you're paying for options versus how much you're selling them for. So let's review everything right now. Let's get back to basics and review everything ahead of what about could be a highly profitable opportunity, possibly the most profitable opportunity when we look at everything from the standpoint of how much you're paying versus how much you're selling stuff for. Okay, so we've identified these Apple divergences. This is important. This is important. Because, and Apple is the stock that appears to be as if all institutional investors just got together and let's say, hey, we're going to upgrade Apple for like a number of months. We're going to keep raising target prices. And as long as we do that, well, the rest of the market will just follow. Well, we're at a point now, after they've been doing that for 3 months, to where, look, yesterday we got an upgrade, or the day before, and what happened? Apple price actually went lower by $5-6. So all of a sudden, this type of behavior that we have witnessed have been so solid over the last few months, it's gone. And this could be a sign of a definite top. Now, once we combine that information with the move 11, which clearly is dominating the markets once again, this is another sign of a top. And the sequence points to a definite top. I'm going to draw some parallels later at the end of this video. Now, here's another divergence that we've been talking about. See, when things going as usual, okay, typically we don't see this many divergences in the market. But what's going on? So Aramco shares are beginning to trade overseas, and the shares are up 10%. Well, you would think if the largest IPO in the history is up 10%, well, Jesus, the market should be up like all green, big time, all over the board, but they're not. And more importantly, since this was the reason why everybody was so damn bullish, oh, Aramco, oh man, they have such a vested interest in keeping the oil prices high. They're not going to let oil prices, they're going to make sure the oil prices keep going higher. Well, if that's the case, then why on these great news of Aramco shares trading up 10% overseas, why isn't the oil breaking above this key level of 59? The point is, if it's not going to do it now, it is not going to do it in the near future, period, which is another top. Okay, and on top of everything, we're noticing too many RSI versus price divergences that are actually, over the course of the last 72 hours, this divergence continues to accelerate, which tells us that the drop-off is very, very near. In this type of market environment, what you don't want to do, you don't want to get too tricky, guys. You want to use the basic stuff, and ideally you want to short stocks that are going to be highly profitable when it comes to options. So in this case, we want to continue staying short with Netflix. Options are cheap. The drop of $20-30 could be very real in just a few days. BKNG options are historically super cheap right now in relation to the type of the move that BKNG shares could make lower from here. Amazon is in a complete doghouse. Officially, Amazon is trading under the blue. In other words, institutional investors have no interest of actually buying Amazon shares here. So if Apple was able to pull this market higher, irrespective of whether Amazon shares have been struggling, imagine what could actually take place if Apple begins to unwind rather rapidly, Amazon continues lower, and maybe some of the other sectors begin to sell off. Specifically, the sector we're talking about, something like financials. But before this, let me show you what's going on pre-market, guys. So far, we've got, after the market closed yesterday, we're getting a move 11 after hours. After hours yesterday, market closes between 4 and 7, we're getting a move 11. Interesting coincidence, pre-market between 2 and 4 a.m., we're getting another move 11. Well, hold on. Didn't a day ago we just lock in and move 2 with the behavior of an 11, which led us to an overall move 11 yesterday? Guys, this is very, very interesting, and this is not a coincidence. Okay, so PRE pre-market, another move 11. After hours, move 11. Monday, you get a move 2 with an 11 behavior. Yesterday, we're locking in overall move in an 11, and this behavior continues. It's about to break lower, meaning the market is about to break lower. So sectors like JP Morgan, the financial sector, JP Morgan is a great example. The divergence begins to show. Okay, so recently, JP Morgan had a gap up higher all the way to 135. Now, 3 bearish reversal candles back to back, closing the gap, bouncing slightly. Look, this stock is about to reverse itself back to the 130, possibly 125 level. And depending on the speed of these drop, I mean, if the financials begin to sell off at the same time with the technology, cloud sector, software plays, okay, they have been the worst sector. Now, if we get a few other sectors to participate in this down move, that's how we can easily get 100, 150 points lower on the S&P from here. Now, I'm recording this. Today is December 11th, about 8 in the morning, guys. And we're going to see how rapidly some of these other sectors are going to begin to sell off after 2, 3 p.m. today. And this sell-off could be rather fast because there are no reasons to stay bullish the market here. Everything has been played out. So there's a lot more negatives that could be developing from here. Now, Apple, okay, is about to drop, guys, big time. So we've noticed this divergence. Okay, things have actually gotten worse over the last 72 hours. So it makes the move lower. It bounces, right, catches again. It creates this thin candle right here, guys. The divergence is now more pronounced. So Apple chart continues to deteriorate. And when this chart continues to deteriorate right around the top, guys, this creates a perfect opportunity to get a great entry. See, what everybody's going to be doing when Apple drops to like 260, they're going to be like, oh, man, time to short Apple. Look, you're already going to be up 300-400% on your puts. So, but again, you don't want to just jump crazily with a huge position. You want to stair step. So Apple bounces to 270, let's say, today before the announcement. Okay, short some. Buy a few contracts. You see that it's breaking below 268, buy a few more contracts. Okay, you want to continue stair stepping in your position as it progresses. Now, Amazon's got the worst chart, guys. I mean, it is officially under the blue for a couple of days now. All these bearish reversal candles we've pointed in multiple videos, we've pointed this orange line every time it gets here, it begins to sell off. Okay, now what's interesting is it's staying here and nobody's interested in buying it, which would be okay because it's done it in the past and then broke out higher. But this conditions right here makes us think, these two conditions right here making us think that actually a move lower is coming in Amazon. So under the blue, now multiple days, okay, combined with a death cross on the MACD, combining with this clear picture of people distributing Amazon shares. They are getting out here, guys. So keep things simple. Just Netflix puts, Amazon puts, BKNG puts. Those are your best movers typically when Federal Reserve comes out with an announcement. So expect a slightly larger moves in those stocks opposed to a lot of other stocks. As you can see, we're not putting JP Morgan as a trade here. We would rather trade Amazon or BKNG or something like this. All the conditions we've discussed in the last few videos, guys, the 5 core bearish conditions, they are still here. Now, they actually appearing more bearish on the chart now. Okay, let's review them real quick one more time. They are against the double top. RSI divergence accelerates. Volume conditions are bearish. Bear reversal candle against the double top, and MACD is very much still in the death cross. Okay, so we went from an S&P chart just 2 days ago from looking like this to looking like 2 bearish reversal candles, and this is the worst looking part because now you got 3 bear candles, and the case of divergency here is actually accelerated. Okay, as the stock struggles to take out this 3150 level, it's still is around, I told you guys, this 31 level, it's like a magnet. Okay, things go above it and they get dragged back to that level. They drop below it and they get dragged back up to that level. Just this 31, it's not going to last very long. So we can easily travel back to this 3048 area. Just keep that in mind. The retest of 31.50 likely to take place one more time at some point today, possibly tomorrow morning, one last time before the big move lower. So all the levels we've discussed, guys, 3025 would be the ideal case scenario. Move 11, we've pointed it out yesterday before actually the move 11 taking place yesterday. So 50-day, we're getting very close to this 50-day time frame of this actually materializing. So we're still using this historic analog because we think it's very, very close. Okay, Netflix puts yesterday didn't do a huge drop. We were getting in at 297 level. It dropped 1 point to like 292. Not a huge drop, but it's likely to drop substantially today. This was a nice and easy trade. AMTN popped, dropped actually way below our target. We said 236 was the first target. Dropped actually to 230 and finished at 232. Guys, just remember, these move 11s, they don't show up simultaneously like that after hours pre-market for no reason. December 10th, yesterday on Tuesday, was a solid move 11. There was actually a double move 11 within 1 day move. So the market opens here, it tries to move higher a couple of times, finishes right very close to where it started. Okay, so it's a solid pyramid, solid move 11. Another way to look at this move is initially if you combine some of the pre-market action, right? Again, you've had this first move 11, and then you got the second move 11, guys. That are definite characteristics of the top 2-day sequence is 211. That is a highly bearish sequence, so you get a pop and drop, you get a bounce and completion of the pyramid. 5-day sequence begins and continues with an 11. So 11, 12, 1, 2, 11, guys, typically ends to multiple bearish moves. I'm going to show you some historical data here in just a sec. So possibly be ready. This is why we want to stair step. You want to actually still give your trade a probability that the market, after the announcement, whether it's negative, positive, it doesn't matter. Like, it's the reaction that matters, that initially the market could drop, pop again in the morning, back to this 3150, and then the sell-off could actually take place, as most of the reversals take place between 10 and 10:30 in the morning. So do not put a huge position. You can start buying some puts. You can add some puts at 3 p.m. and then you really put on a bigger size position once the market picks a solid direction in the morning. So ultimately, the best possible trade is tomorrow morning between 10, 10:15, 10:30. Your puts, if the market climbs back to the 3150 mark, your puts are going to be the cheapest. We're not likely to break above 3150. And if the market begins to sell off on the Thursday, 10, 10:30, you can get 2 solid down days that could make you a ton of money, guys. Okay? And we spotted that 11 on a larger time frame. Yesterday, we pointed out on a 5-day, you get an 11. So today's move clearly is going to be a 9 or a 10. We're leading to a higher probability of a move 9 where the market initially pops and begins to sell off. So pay very close attention to that as it unveils at around 2, 3 o'clock. VIX actually confirms an uptrend. We got second day higher on the VIX, shooting all the way to 16.56 and finishing pretty much slightly above where it started. And it did start above where it started yesterday. So a couple of solid days on the VIX could put us in a situation where today, tomorrow, today, December 11th, tomorrow, December 12th, we'll definitely see the VIX back above 16. And if it does that, that would be the second time VIX is going to be above 16. Actually, it would be the third time VIX is above 16 within a 4-day time frame. And that definitely brings some validity to where nobody is expecting the market to really drop. VIX goes to 20. Market is going to be down easily 100 points on S&P. So this is what we're expecting today, though. We're expecting VIX to revisit that level of 14.93. We're expecting it to hold it. Now, when we say we're expecting it to hold, it doesn't mean it cannot drop to 14.8 or 14.9. But once it does, it is likely to bounce rather quickly above the 16 level. This is some historical data from last year in December. I want you to pay very close attention. This is unprecedented. Like, level of VIX around Christmas doesn't stay at 35, 36 by no means. But I want you to also understand how quickly we have gotten there. So for maybe some of you are skeptical, like, Leonardo, what are you talking about? VIX 20? Like, how are we going to get there? Well, notice where we started December, right? Last year, on the 3rd, we started in the 15 range. I mean, this is where we're at now, okay? 15.9. So 15.9 going to 17.2, finishing above 16. And this is how the shift happens rather quickly. Look, the next day we're in a range from 16 to 22, and we finish at 20.5. Then market chills out a little bit with the George Bush funeral last year. The market's closed. Then we open up, and the VIX moves higher. We're at 26. Okay, then it stays 24, 23, 23, 26. Then makes a couple of moves but stays consistently above 20. So what I'm saying is a difference from being at 15.9 to 22, 20 level, like, it can happen overnight. All right, and another important historical thing here is we just had two bear moves. We had 2 and 11. Okay, they're red moves. Last year on the 17th and 18th, we had a red move and a red move. Yes, VIX was already above 20 here. But then when the Fed was talking about the rates, here comes that move 9. So right now, in a very similar setup where we got two bear moves. Yeah, they're not 3 and 6, but they're 2 and 11. They're both red moves. With the Federal Reserve interest rate announcement, we can get a 9. And 9 in this stop in a rising VIX. See, the idea here is you start the month in the low VIX range, and the VIX is climbing. So we don't necessarily have to hit 26 on the VIX to get this type of moves. But we can easily go from 15, 16 to a 20. Okay, and we can get 2 red days. And your ideal point is to enter the position about 10, 10:30 tomorrow morning. Okay, in the expectation of a continued drop through the rest of the day on Thursday and through the rest of the day on Friday. Okay, so keep that in mind as you're trading, because it looks like the setup can actually produce this. This is what we've got so far, right? So we're getting to 211. Now, this is this month's calendar. We're positioned with a high probability of a 9 today, followed by a high probability of 3 of the 3. Okay, so this is your trade right here, guys. With that said, okay, key takeaways is you don't want to jump all in. You want to begin to stair step. 10:30 a.m. today, 2:30 to 3 p.m. today, I should say today, 10:15 a.m. tomorrow. So split your position. Again, if you're trading 12 contracts, don't buy all 12 at the same time. Buy some this morning, add some in the afternoon, add some. The biggest add should be here at 10:15, right? 10:30, 10:15 a.m. tomorrow morning. So your idea is to also add when market is bouncing, ideally to a level of 31.40, 31.50. With that said, trade like a rock star, guys. I'll catch you on the next trade tomorrow.